And now our Vice Chairman, John George, will take over, please.
Thank you, Neeraj. Past President Sri Prabhullaji, Past President C.A. Amarjit Chopraji, speakers of today's webinar, past chairman, sponsors, representatives, invitees, guests, professional colleagues, members from other chapters, ladies and gentlemen, good evening. It gives me great pleasure to welcome you all to the Global Accounting Conclave IFRS Series 2 on going concern and impairment of assets. Our keynote speaker is C.A. Prafulla Chajat, past president ICAI and chairman of the World Congress of Accountants 2022. Sir, we are honored to have you with us today as our keynote speaker. Thanks for accepting our invitation and we welcome you. We also have today C.A. Amarjit Chopraji, past president ICAI. He will talk on COVID-19 impact on going concern. He will also be part of the panel discussion. We are pleased to have you here, your presence today, sir. We welcome you. We have CMP Vijay Kumar, Chairman, Accounting Standard Board of India. We are fortunate to have you, sir, here with us. Vijay Kumar ji will be part of the panel discussion. We welcome you. We have C. Abbas Ali Mirza, partner Deloitte, to update on the last webinar details and to brief on the theme on today's webinar. He has provided a lot of support to organize this mega event. We welcome you to this IFRS webinar series 2. We also have Mr. Scott Wahalen, partner Deloitte Middle East. He will talk on COVID-19 impact on IFRS. We welcome you, sir. C. Umesh N., partner at Conclave, is the moderator of today's panel discussion. Umesh is a great supporter of our chapter. Welcome, C. Umesh, and hope we'll have a lot of learning from your panel discussion. We have few PDC webinar lined up. Our next PDC event is scheduled on 12th of August 2020. That's a Global Accounting Conclave webinar, IFRS Series 3. It's on IFRS 16. On stock market and financial planning, we'll have a webinar on 19th of August. And on 26th August, there's a webinar is scheduled on litigation funding. There are also other PDC webinars which are under planning, like Excel to balance sheet, Power BI, blockchain, and similar interesting subjects. Details will be announced in due course. Our chapter is planning to have a career development webinar for students in the month of September. Our committee has put a lot of efforts to bring this IFRS series, and especially our PDC team, CA Ajay Singhvi and CA Mohammad Shafiq has done a lot of efforts, and our chairman, CA Neeraj, has done a wonderful job in organizing this thing. So much efforts behind this event. So let's utilize this webinar to enhance our knowledge on IFRS. Now I request C. Abbas Ali Mirza to update on last seminar and brief the theme of today's webinar. C. Abbas.
Thank you very much, Mr. George. And it's a great honor for me to be part of this Global Accounting Conclave series, which has been conceptualized by the Abu Dhabi chapter. And we are getting in every, right from the beginning, as we say that we've started the series and a journey has begun. The first step, as they say, for every journey of 1,000 miles, you have to take the first single step to begin it. That single step was taken last week, and then we are on the journey right now. So we covered IFRS 9, and now to give you a little background on the COVID-19 for those people who've not been there last time, let me first start with no negatives, but about a very positive thing that just happened this yesterday. in the papers, if you have read, that is probably a positive thing that we have seen coming out of the COVID-19, is that Amazon and Facebook, they kind of shrug off the coronavirus recession, and Jeff Bezos and Mark Zuckerberg, they gained more wealth. I mean, virtually. In a single day, they became richer by $14 billion. So there are positive things that are happening. While we understand that we are at a pivotal moment in the journey of survival, but I think there are some positives that are coming out for certain industries. Well, as we know that, as per the IMF, the cumulative output losses that they are predicting for the years 2020 and 2021 would be around $9 trillion. That's a lot. And they say this is the first time since the Great Depression of 1930 that both the advanced economies and the emerging markets and the developed economies are all going to be in recession. Let me tell you that this is going to be a big challenge, as we all understand. So in these series, as I told you earlier, we covered IFRS 9 and the impairment. Today, we're going to take up a very important topic also, which is the impairment of assets under IAS 36 and the going concern assessment. Now, before we get into, before I invite the speakers to come and address on these topics, from my personal experience, I believe that when you do the impairment assessment under IAS 36, and when you're especially doing the value in use and the fair value assessments, it's very important for us to be sure as to what kind of projected cash flows we're going to be using for the purpose of the assessment. And I think that brings in a lot of new things, especially in the COVID-19 with the uncertainties. And also the assessment of going concern is very important from that perspective. So I would draw your attention to the certain standards under the ISA, the International Standards on Auditing, not the IFRS, especially ISA 700, which talks about the opinions that you give under the auditor's report, 701 and 705, especially regarding the modifications of the opinion, 706, which is how you add the emphasis to your audit report. And the most important under these circumstances is 570, which is ongoing concern. And I think something that we need to definitely consider is ISA 540 revised, because that talks about how does the auditor actually go and look at the accounting estimates and the related disclosures, which is very, very, very important for us to do. Now, I would like to, in closing, try to also draw attention to certain changes that have been made at the IFRS, especially the ISB's conceptual framework, which has been revised in 2018. For all of us who've been following the revision, you know that a new thing which was there earlier but withdrawn, the concept of prudence has been added to the framework. And as we all know, prudence is exercising caution under the conditions of uncertainty. So under the COVID-19, I believe prudence has to be exercised, and very much rightly in time, the ISB has added that to the conceptual framework. Now, another very important thing which I think we need to, under these circumstances, consider is the key judgments that that management makes and the assumptions and the sources of estimation uncertainty that disclosures are required under IS 1, paragraph 122 and paragraph 125 of IS 1. That is extremely important, that the way that you look at these assumptions and you make disclosures, and you also talk about the major sources of estimation uncertainty that you need to make a lot of disclosures under IS 1, 125 and 122. It gets very important under COVID-19 especially. One thing that I think a lot of people have probably not noticed, I mean, probably they have, but I think the definition of the word materiality has been amended by the ISB. And what is important is that they've added something which people will consider as not a great addition, but actually it has a lot of meaning. The way that they've added a word to it, they're saying that normally we think that materiality, in order to be that, has to be something that is disclosed and the way that it's presented in the financials. But I think the new definition includes a word called obscuring. They said if you try to put things in the footnotes, and if it is in the meaning of the term obscuring under the new definition, if you do that, even that is material. So what they've done, they've told us in the amendment that there are 5 ways in which you can obscure the information. So the language can be vague and unclear, that is obscuring. The information can actually be scattered in different places of the footnotes, thereby not giving the impression that the financial statement user has to use it from looking at different parts of the footnotes. So that by scattering it to different areas, that's also obscuring. By taking dissimilar items and inappropriately aggregating, that's also obscuring. And by taking similar items and inappropriately disaggregating them is also obscuring. And very important thing is, which I think a lot of lawyers are very familiar with this, is trying to hide information by adding immaterial information along with the relevant one. This way, people do not actually concentrate on the right information. This, I believe, will be a very important consideration under the COVID-19, because companies might resort to trying to use some of these techniques which I've talked about, which they call as obscuring. And what I need to tell you is that auditors are going to be watching for that. And that would be a material item for the auditor to look for, and they may actually qualify their opinion. So need to be very careful. So with these, I'd like to thank the Abu Dhabi chapter for giving this opportunity to me to be part of these, the global accounting, the conclave that is happening, which has already been kicked off, last week, and will go on for another week. And it's a great opportunity, I think, for people who are attending this conclave to know a lot of new things that are happening, and which people should actually look at in a very, very, I would say, focused manner, because this is the time when you need to be looking at this stuff, to making a lot of provisions, to getting ready with the COVID-19 impairment, provisions under the COVID-19 and the other financial statement implications. So with that, I'd like to invite the next speaker, who's going to do a keynote address for us. We are absolutely honored to have Mr. Prafulla Chajar, who is the former president of the ICI and currently the chair of the Executive Committee of the World Congress of Accountants. Now, World Congress of Accountants is not just a small meeting that takes place. It's a meeting of all the accounting bodies of the world, which are part of the IFAC. And that is a huge meeting. I've attended personally many such meetings, once in Paris and once in Turkey. It's a huge gathering. And I think India should be so proud to be hosting it, and also to have Mr. Prafulla Chajar, our own, very own Mr. Chajar, to be the chair of the Executive Committee of the World Congress of Accountants to take place in 2022. He doesn't need an introduction. We know that he served in the Institute as the president for the year 2019-20. He was elected as the Executive Committee Chairman for the World Congress of Accountants 2022. And we are really looking forward under his leadership to deliver a World Congress in 2022, which is unparalleled. And I have all the hope that under his leadership, the World Congress will be something very different than what has happened in the earlier phases. So with this, Chajarji, I welcome you to address this the Global Accounting Conclave.
Thank you so much, Abbas, for those kind words. Very good evening, distinguished members of the panel, respected past President Chopra sir, who is always been guiding all of us for last many years, and especially when it comes to accounting side and auditing side. His always views are always, having a sort of final words. Thank you so much, Chopra ji. Let me start with congratulating our own team from Abu Dhabi chapter under able leadership of dear friend Neeraj ji. I had seen his working last year when he was the vice chair. Now today is the chair, and entire team of Abu Dhabi chapter. They got a lot of energy with them, and probably this particular time when world is also finding the solutions, nobody is having the clear-cut answers how to tackle with the various accounting, auditing issues related to one small virus that is COVID-19. And I think that has, already shaken up the entire, not only the human beings, but the entire economies. And therefore, my compliments to Neeraj Bhai, to you, John, and your entire team for organizing this kind of webinars, and wherein, on the global platform, people can get connected, they can talk, and they can, discuss various things. As I mentioned, Chopra ji is also there. My dear friend MP Vijay Kumar, who is also the chair of the accounting standard board of the entire ICI, he's also there. Scott, Umesh, and of course my dear friend Abbas Ali, who has been always been speaker at many seminars, conferences. A dear friend, he's also there. Abbas, you just mentioned a very good news that somebody's fortune by millions and trillions have increased. But we the accountants, we are always worried when something is going on a negative side. We don't get happiness because our audit fees remain the same. So I don't think it's just because Facebook and others are going to get their monies. But what is very important, what will happen to companies like air industry, air in BNB, maybe hospitality, hotel kind of industries, where you and I, we are the auditors. And that particular time, and I think today's topic is about going concern, impairment of assets, has lot of significance, because we all are trying our best, and most of us also survived because of this COVID-19 pandemic and all those things. Now from survival to revival. And when at the time of revival of economy, lot of things, the governments, various governments are supporting, industries are trying to do their best, but it is the role of the accountant also to be in line with what is happening across. We are at the same time, we also have to safeguard our own, responsibilities, and then only you can actually contribute for that particular revival of this economy. So therefore, very critical time for the accountants as well, same equal to the maybe probably the industries are having. And therefore today's topic is about going concern and impairment assets, according to me, holds a lot of significance, because it is this particular thing that is going to make, after one closure of one financial year, they will be able to sail through the next financial year. If auditors are of the opinion, if management is of the opinion that because of this COVID-19 small virus, our, the entire going concern, and Abbas, I can just talk to you also when you are talking about so many good news. Yesterday only I read one of the, very huge company, they have changed their auditors because there was a difference between the management and the auditors about the going concern basis, and probably that was the reason. So this kind of challenges, even globally the accounting fraternity is going to face. There are challenges because historically no management has visualized that suddenly their businesses will go out of all these billions and trillions. Companies will also be impacted. Again, for them also huge challenge in terms of identification of various parameters, be it internal or be it external, what are the things that are going to impact their operations. And probably together we will try to find out certain maybe certain solutions or maybe a way forward. And when we are talking about IS 36 and going concern, I don't think we can talk in isolation, because so many factors are going to, will be very important. Like it is not only IS 36, IS 16 about property, plant, equipment, IS 37 about provisions and contingent liabilities, contingent assets, then IS 2 about inventories, where we talk about net realizable values, NRVs. So it is not only one, IS we are talking. Probably the speakers, I'm quite sure the kind of experience which they are all carrying with themselves. So they are going to talk and cover all those relevant things also, which will make this entire, learning a great experience for all of us. And as I said in the beginning, nobody is having a, clear-cut solution. Okay, now in COVID happened, now you do this particular thing. Like, world is, the medical fraternity is finding yet to get, proper medication and vaccines and all those things. I think the accounting fraternity is also globally is finding what should be our roadmap. And I think thanks to technology, right from the IFAC to IFRS Foundation to the various institutions globally in India also. As the Institute of Chartered Accountants of India, we are also doing a lot of work in supporting, the accountants and the Chartered Accountants fraternity, and also the business community. What could be the challenges, what could be the roadmaps, what should be the carve-outs, and how together we can go into this particular journey where we are not not at the against the businesses going forward and all those things, but at the same time, what is globally accepted from this entire profession of accounting, that we should be given, very proper views and all those things. So therefore, this going concern is going to be very, very important. As we have, so many distinguished speakers, I will not like to speak further, but just to, thank you for about mentioning about the next World Congress of Accountants. Yes, unfortunately, because of this pandemic, the activities are a little bit slow, but I'm quite sure next couple of months, we at the ICI will take it further, and definitely it is going to be a great show where all these my chapters like Abu Dhabi chapters, all these, the viewers, the speakers, the panelists, and I'm sure this today's we are having this global accounting conclave where people are also participating across the globe with their support. The next World Congress of Accountants 2022 will be a great show, and I sincerely seek everybody's support, not only in terms of attending that conference, but also in terms of what could be your suggestion in terms. Very soon we will be coming out and reaching to various institutions across the globe. So do participate into that particular thing. Please give us feedback so that we are in a better position. Ultimately, it is going to be the World Congress. It does not, I say, is going to just be host, but I think it belongs to the entire profession of accounting, and not only the accounting, that is the showcase event of the entire power of the accounting sector to the world. Various academicians and politicians, they are going to attend. So I look forward for tremendous support, which I am getting all these years from all my chapters and every individual members. I am the today past president. Chopra ji is in a different capacity. He comes to give the guidance. I am not here to give the guidance, but thanks to all of you for your love, affections, and good wishes, that even though I am the past president, but still people are inviting me here. And before I conclude, once again, I would like to, I'm quite hopeful everybody is taking care of your health as well, because now we are coming out of our offices and trying to, do our responsibilities in while executing your work. Please take care of your health and your family, and quite sure very soon we will be out this individually out of this medical pandemic, and together as the profession out of these the challenges which nobody could visualize in the past. But definitely this particular time, this is going to be a good roadmap, how the vision should be there for the accounting fraternity, also for the various institutions also across the globe. And as I said, IFAC, IFRS, foundations, various institutions are taking lead, and look forward for that kind of support. Thank you, Neeraj Bhai, once again for inviting me here. I wish you all the best for keeping all the activities of the chapter. And chapters like you are also, like a brand ambassador of the profession, which are keeping the good thinking of the ICI also and connecting the world together. Thank you, Abbas, for your kind words once again, and look forward for the deliberations. Thank you so much. Thanks a lot.
Thank you, sir. Thank you for such nice words. And we hereby commit ourselves for the event in full respect. Whatever way you want, we are there to support you for World Congress of Accountants. And please bank on us. Please advise whatever we have to do. We'll take care of it. Thank you so much.
Thank you.
All the best, sir, for the World Congress. And I'm sure that you will not only do the World Congress, you'll do a world record with the World Congress.
Sir, you include all of us. It's not the Praful or it's not the ICI. I think every individual who is the, as the accountant and qualified to be accountant, it is the global event, and we will going to be have that particular thing in mind. So together we will do it, sir.
Thank you, CA Praful Chhajarji, for your wonderful brief thoughts on going concern, also about the update on World Congress, and your inspiring words for us. Thank you. Dear friends, today we have the galaxy of speakers today. So we have 4 speakers. The senior most, Shri Amarjit Chopra ji. Then we have Mr. Scott Vahalan. We have CA Vijay Kumar ji, and also CA Umesh. So first two speakers are going to cover the first session. So I would like to thank Neeraj and Ajay ji for giving me an opportunity to introduce the wonderful speakers. So we will introduce first two speakers, and then in the panel discussion, another two speakers. So first I would like to introduce the senior most, Shri Amarjit Chopada ji, who is a highly acclaimed chartered accountant for more than 45 years. Sri Chopada ji is a senior partner of GSA and Associates Chartered Accountants, New Delhi. He was the president of Institute of Chartered Accountant of India during 2010-11 and vice president the year before. Indeed, Chopada ji's full profile is larger than life. So I would just like to very briefly mention about his achievements. So Sri Amarjit ji was also chairman of National Advisory Committee on Accounting Standards by the central government for 4 years. He has recently been nominated by Government of India as a member of National Financial Reporting Authority. Sir has been nominated by central government on bench 2 of disciplinary committee of ICI for a period of 4 years, starting 2018 to 2022. He was also nominated by central government as chairman of committee to revise company's auditor's report order 2016. He was also nominated by IRDA on standing committee of accounting issues in insurance companies. Sir has also chaired several important committees that dealt with auditing and accounting standards, corporate governance, and banking at the national level. Shri Amarjit ji has also been conferred honorary membership of the Institute of Chartered Accountants of Australia and New Zealand and honorary life membership of the Association of International Accountants, London. He has contributed significantly to the development of auditing and accounting discipline in India over various years. He was responsible for introducing IFRS certificate course in India and Middle East. As a prolific speaker, he has delivered more than 2,900 lectures on various topics, including accounting and auditing standards, IFRS, banking, including financial inclusions, insurance, corporate laws, corporate governance, ethical standards, peer review, both in India as well as abroad. He is presently on the board of many big corporate houses, and he is going to speak on COVID-19 impact on going concern. So we welcome you, sir, and also would like to introduce simultaneously the first speaker, Mr. Scott Whalan. Mr. Scott is the partner in Deloitte Middle East Specialist Valuation and Modeling Business, also the Financial Advisory Family Office Leader for Deloitte. Scott has over 15 years of experience in valuation and modeling advice spread across Middle East, Europe, and Australia. He has operated across a range of industries and provided valuable valuation advice in a variety of contexts, including mergers and acquisitions, financial reporting purposes, fairness opinions, purchase price allocations, corporate restructuring, and dispute resolution. Prior to moving to Deloitte Middle East in 2009, Scott worked in Deloitte's Australian valuation practices. Clientele includes large family across the region, large corporates, and GRE of various forms. And Scott is also a chartered financial analyst, charter holder, and he is going to speak on COVID-19 impact on IAS 36 impairment of assets. So we would like to welcome both our speakers, and over to you, Mr. Scott. Thank you.
Well, thank you very much. And must I say at the start, I mean, it's a great honor to be here and to be invited to participate in this. I appreciate the caliber of speakers here today, and it is a great honor to be a part of this, and I hope it is useful to the attendees. I will just present my slide. I have some slides to show. Let me just bear with me. If you could just let me know if you want to see them.
Yes, Scott, we can see that. Yeah.
Okay. So let me, I guess, topic of conversation for myself today is IAS 36 impairment of assets, and with focus on the impact of COVID-19. Let me just start, I guess, to set the scene. I guess it's fair to say that valuation theory hasn't changed. but the complexity and the nuances and the volatility of markets has. And that's where I guess, and I'll probably say this many times tonight, but around the common phrase across our profession is we're just needing to use more tools in our tool belt at this stage, rather than anything fundamentally changing. But understanding the limitations and the environment we're in is the important piece. So if I just go to, I guess, what I'm going to cover tonight is just setting the scene around IAS 36 requirements on impairment testing. You know, why is this important? It's been mentioned already by the previous speakers around, you know, this is, you know, a requirement from the standards and something that is very topical at this stage as we're coming into June and December reporting periods. I'll also set the scene around some of the market insights, many of which I'm sure our attendees will be aware of, but just to understand how this is impacting valuation, and then moving towards more the technical aspects around impact on financial reporting and how some of the valuation metrics has changed over time. And now also as a profession, we are dealing with it. So to set the scene, why is this important? IAS 36 requires that we review the impairment to be carried out annually or in the event certain triggers are raised. Now, I will come on to those triggers later, but I think it's fair to say that we're all aware that, you know, clearly COVID-19 has impacted many businesses and certain triggers have been hit in one form or the other. And so an asset is impaired when the recoverable value is less than the carrying value. Recoverable value, for better use of word, is the value that we would assess as auditors, as valuers. If that is less than the carrying value, then the standard says you must take an impairment. This applies to all in scope assets. Obviously, different tests across different types of assets. And you know, goodwill, obviously, impairment testing is always carried out in the context of a CGU or group level. I guess it applies to goodwill, intangible assets, right of use assets under IFRS 16, property, plant and equipment, and investment property. So it covers a wide range of areas. And to be honest, a lot of these aspects I will be talking about also cover areas around fair value accounting also. So they are applicable across multiple areas of financial reporting. And so I guess the challenge we all have now is what is the recoverable amount of your asset? And by the standard, it says it's the higher of the value in use or the fair value less cost to sell. Value in use being the present value of the future cash flows expected to be derived from the continued use and subsequent disposal of the asset. And it's based on certain rules and guidelines given by the standard. You must be using financial budgets and forecasts, composition of cash flows, discount rate and time value of money, foreign currency cash flows, restructuring are all areas that must be going into the value of use concept and calculation. From a valuation perspective, we look at that like a discounted cash flow for sort of the common terminology. Fair value less cost to sell. I mean, that is, I guess, broken up into more categories. Either the price in binding sale agreement, which is unlikely to be a case in most instances, whether there's a price in a particular asset that you can rely on as a guidance to fair value. Pricing in an active market, so looking at the market price, for example, for a listed company. Or looking at then the best information available. And typically in fair value less cost to sell, the standard practice is typically looking at market multiples and previous transactions. And I guess with that in mind, I wanted to just paint the scene around why this is relevant for impairment testing. And then we'll go into now a lot of these, what has impacted some of these cash flows or the market multiples that will impact the calculation of that recoverable amount, which then obviously provides the challenge when we do impairment testing. So let's take a look at the market. I guess just again a recap. Now, what I presented here is the United Emirates Market Index, as well as the Dubai Financial Market Index as well. And clearly, as we all know, the markets took a very big hit in late February, March, and since then have recovered. Now, as we've all read in the papers, a lot of the recovery has been driven by the FANG index and the technology companies bolstering the market recovery up, which I guess can explain some of the rebound of the S&P 500 relative to the local market. But again, the local markets obviously haven't recovered to previous highs and are below those levels. Similarly, the oil price has declined, went to negative as we've all read, and now is somewhat recovering back to sort of the 35, 40 levels. So clearly in the region, the Middle East, we have been hit by two factors, both the wider global impact of COVID-19, as well as the shock of the oil price, which is impacting the broader economic indicators here in the region. What I presented here is just to show the volatility in some of these multiples by industry. And again, this is across the region, GCC. Just showing in the circles there is the percentage drop in market cap by these industries. Obviously, hotels, restaurants, and leisure have taken the biggest fall across the regions, as well as utilities and other industries. What is interesting, obviously, you see that the drop in the multiples, these are EBITDA multiples as at December 19, March 20, and June 20. Clearly, the share prices has impacted the multiples as of March, but since then, with the recovery of the share prices, we've noticed the multiples now reverting back upwards. Common question is, why is that? The answer being that there is a lag, and with the earnings results not out yet, and obviously this is the challenge coming into the June quarters, March quarters around the reporting and impacting the financial statements or the EBITDA numbers to reflect these in the multiples. So clearly the share price is driving a lot of these market trends rather than earnings necessarily, given the natural lag that we have in reporting. Similarly, this is just breaking down the price to book value multiples based on banks, real estate, insurance, because typically rather than EBITDA multiples, you would value a bank, value these industries based on a price to book multiple, showing the depressed multiples of those both times. Clearly, real estate at less than 1 times is an indicator around certain considerations around impairment, but showing that there is volatility in these markets also. What I've presented here is, again, the price to book value multiple of across the industries. Why have I presented that? It's because I guess when a business is trading under its book value, there is an indication, that's one, industry indicator around impairment and potential revaluation of assets across these industries. Clearly, there's a lot of industries under book value, and clearly real estate, banks are all under one, construction, engineering. EIU have looked at the various industries and do present the table there at the bottom shows their view on what has taken the short-term impact of COVID-19, as well as their view on where the long-term impact could be across sectors. Clearly, information, IT and technology has had a neutral, if not positive, short-term impact, and there's positivity in the market around its long-term stability. Similarly, on the pharma and healthcare, tourism and leisure, as well as transportation, logistics have faced issues in the short term. However, from a logistics perspective, there is a positive outlook from an EIU perspective on that. And this, I think it's fair to say, has been reflecting a lot of the share price movement since those March lows, which is in line with that indication. What we present here is an allocation, a review of the market and looking at the goodwill across the market. So across the different geographies, across the different industries, where is goodwill sitting on each other's balance sheet? And why am I looking at that? It's because I guess where is the initial indicators where there may be impairment issues around the goodwill carried by these entities. So what's interesting is Kuwait, Saudi Arabia, and UAE, companies trading on those markets have, by their nature, have the highest levels of goodwill seen on their balance sheet. And across the industries, it is fairly evenly spread. Construction, engineering, and oil and gas being the two top industries having most goodwill, which will come onto oil and gas potentially later. But I guess that is an interesting dynamic for me as a valuer, looking at potential issues around impairments across those sectors. And probably equally the places to test and watch in terms of where we need to focus on from an impairment perspective. What I've showed here is more the macro level indicators across the UAE. Now, I'm not sure if you can see that. So what the light green, what the different bars there reflect the forecast as at those dates. And what we wanted to show is how the forecasts have changed over time as we've moved through this pandemic. So obviously in January, we were all very positive and inflation was positive and the trend was up. April, initial view on the world, forecasts were getting revised. And as we've moved through this, the forecasts have obviously taken a bigger hit and the world has become a little bit, I guess, a bit more gloomier as the pandemic continues. And I guess why is this relevant from a valuation perspective, and we'll come on to it, is these drive a lot of the terminal value levels, a lot of the broader long-term picture of a lot of these companies. And this, I guess, trend and dip and its conversion back up to back to normal levels impacts the trend analysis that may go into your cash flow analysis also. When we look at, this was an interesting analysis done by EIU also, and it's a similar concept around what their view of the market was in February 2020. Then they revised their view in March 2020, and then they revised it again in August 2020. So originally they thought the recovery period was going to be 4 months of business as usual. As the pandemic developed, obviously a lot of the predictions were then recovery period back in 2021, economic impact limited to tourism and commodities expected to be weakened, and it was a little bit more, I guess, focused opinion on where the impact would be. As we moved into August, obviously the world is a different place. They're predicting recovery not until 2022, and assuming the vaccine develops, expected to take a year. Where we go from here, I guess, is a challenge. And these are, economists and people getting paid to do these reports on a daily basis. So it highlights the challenge that we all have. But I guess it does show that the world is moving in a very fast pace, and the ability to predict this is obviously challenging. But we as valuers, accountants, auditors have to sort of deal with this. So let me just. So now, what does that mean from a financial reporting perspective, and how do we sort of take those broader concepts and the volatility in the market into our analysis from an impairment perspective? Before I get into the valuation areas, I just wanted to touch on some of the broader concepts before I go into the discount rates and some of the technical terms. Now, as this pandemic has changed the way we're assessing values, it has driven potential changes in the way we're assessing, value in use and recoverable value. Previously, we may have used level 1 or level 2 inputs and been able to get comfortable around that. Now, I think, given the extra volatility and the challenges around that, we may be forced to now look at level 3 based input. In terms of assessing the impact of the triggers, we must look at we must be satisfied, and there will be challenge around auditing and review evaluations around, have you considered these triggers and how have you considered them? And just to remind everyone, the triggers there on the right-hand side around store closures, loss of customers, supply chain interruptions, distribution network exports, human capital, all these, it's fair to say, I think most businesses would have had this in one form or another. And then I guess reporting date is obviously a consideration around what was what was the case as at a point in time, and around the relevant disclosures around that, which goes towards the accounting aspects of this. Other considerations that we are considering, it's around stimulus packages. Obviously, the governments have supported businesses in very many forms, and understanding how that has been factored into different cash flows, the markets that these businesses are operating in, the comparable companies, which I'll come on to, understanding the sort of macro elements of this and how that has filtered down into the businesses is the important aspect. Because many instances previously we got around, we could narrow our focus around an industry or a particular company, because I guess everyone was, the economies were all going along in a similar fashion. Now, obviously, different governments have reacted differently, and different support has been given to different industries. And understanding how that has filtered down into your particular asset and business is important. The other one I'd like to talk on is portfolio valuations, and this very much relies on my work that I do with family offices around understanding the views on value from both an investee company level as well as the holding company, and making sure there is an alignment between how that business has been impacted and how it is going to recover. And it's important that the look-through analysis is carried out to fully understand that, so there's no inconsistencies around potential impairments at the investee company level or different assumptions that aren't consistent at the holding company. I won't touch on liquidity and funding because I think that is very much on the going concern point, but obviously there is a need to make sure that we don't stand behind the theory and forget the going concern issues, but I'm sure that will be touched on later on. So what does that mean? We're now at a position where there's a lot of noise in the market, there's a lot of uncertainty, things are changing daily. How do we record? How do we assess the recoverable value? Now, just as a snapshot, there are very many valuation approaches. Discounted cash flow analysis, which relies on, or under the income approach, inputs into that are free cash flows, discount rate, terminal growth rate, typically the sort of three elements within an income approach. And then you've got the market approach, which can either be split into comparable companies, looking at public companies trading in a various market, as well as comparable transactions. That would, under the market approach, that would drive you based on a normalized earnings number as well as an earnings multiple. Based on those two approaches, that would get us to an enterprise value, and from there you could get to an equity value, which would obviously be the important point when you get to the recoverable value. If we just focus on the discounted cash flow analysis, and in particular discount rate. So again, so if we're looking at a recoverable value and we're looking at a value in use concept, one of the key elements is obviously the discount rate and the cash flows. How have discount rates changed? Now, a discount rate is typically built up by a risk-free rate. Then you might add on other risk premiums for the market, country or equity market risk premiums, and then you might add on other size and specific risk premiums. That would typically get you a cost of equity, and then you would weight that with a cost of debt to get you to a blended discount rate based on a cost of equity and a cost of debt. What I presented here is how some of the variables have changed over time that build into that discount rate. A common question we get asked is, how have discount rates changed? What's the impact on the discount rate because of COVID? Now, to answer that, we need to look at the individual factors that build up into the discount rate. If you look at the risk-free rate, obviously it's come down considerably across the world. So typically people might think that the discount rate generally has gone down because of the risk-free rate, which is true in part, but then you have to then consider other risk premiums. What you see there on the right-hand side at the top here is some of the country risk premiums and how they've changed over time. A lot of this is built off credit ratings of countries, credit default swap rates, and how the riskiness of certain equity markets has changed over time. Generally speaking, country risk premiums have gone up over COVID, as well as the equity market risk premiums have gone up. So all in all, based on those two risk premiums going up, offsetting by risk-free rate going down, and just assuming we keep size and specific risk premium the same, which is typically the risk associated that we might put onto the cash flow projections, in our view, cost of equity has either stayed the same or generally gone up over this period as a result of COVID. If you look at the cost of debt, there's two ways to look at that. The risk-free rate has gone down, but also the corporate spreads have also trended upwards if you take out the stimulus packages. But there is a higher spread, and I think that is fair to say over time, and we'll get to that. So cost of debt is either staying the same or potentially going up. Debt to equity potentially staying the same or going up as banks scrutinize borrowing a lot more, which overall, in our view, is leading to overall discount rates either staying the same or increasing as a result of COVID. And that's not my assumption. There is the cash flows have been risk adjusted, so my specific risk around the riskiness of built into the cash flows has stayed the same. All in all, on a like-for-like basis, discount rates typically have either stayed the same or gone up. So moving now to cash flows, the other element in value in use. Now, this is obviously a challenging area. We need a crystal ball, all of us do, but there are ways around it. Now, what we are advising our clients is to ensure that they are updating their business plans. It's important that you have your short-term cash flows analysed, you're fully reflecting what you know into those cash flows. And to be honest, I think the common theme is running scenarios. The importance is that no one scenario is as probable as it was pre-COVID, and it's important to understand the various scenarios based on the different circumstances that that particular business will achieve under various assumptions, and quantifying that to understand the impact. An important point to consider is a lot of the value from value in use is driven by the terminal value, which is the value that's typically assigned to after you develop your 5-year or 10-year cash flows, you then assume a going concern that then you capitalize those cash flows into the future. Typically that may be a 50 to 60% of the value. So what does that tell you? Sometimes the value may not be completely, the path to get to that terminal value is important, but also the end point is also very important because that is driving a lot of the value. So running the scenarios around getting to that end point is important, but also how does the macroeconomic output look from from an industry perspective, from a country perspective, to have confidence of that, the recovery or the U curve or the V or the Nike tick or whatever it is, but where do I end up, and then what confidence, and then what scenarios am I running at that long-term view on the company? So that's, I guess, yeah, assess the duration of expected impact, time for the business recovery. And I think when we're the biggest extra analysis that we're doing from a valuation perspective is around comparing scenarios and building different rationalization around the most probable scenario or the most likely, and how the value changes over time. If I just go to how the actual cash flows are impacted. So if I just work through, I guess, a typical cash flow statement, you have revenue, margins, working capital, and capital expenditure. I think it's fair to say that everyone expects 2020 and 21 to be lower, but again, it's that medium and long-term outlook and the long-term expectations of macro variables, which is also important, and we shouldn't lose sight of that within the valuation calculation. Running the scenarios around getting to that endpoint are important, and also the impact on that. When we look at margins, the key here is to understand the fixed versus variable cost framework around a particular business. Clearly, revenue has been hit, but also costs have been adjusted in many businesses, and certain actions have been taken by management. And to be able to reflect the permanent and temporary changes in the cost structure are important as well. It's, you know, typical mistake we see from a valuation perspective is we look at revenue and then we just assume margins stay the same with revenue, which is not completely true. Obviously, businesses restructure, adjust their cost base and adapt. So that's the other important thing around the low fixed cost absorption and understanding how that may impact EBITDA margins. When you look at working capital, you know, as we can all experience, I'm sure it's well known to the attendees around the challenges of getting receivables in this environment. How have you modeled that through the short-term cash flow period? Clearly, we are going to see a challenging in our working capital profiles over the near term, making sure that's fully reflected, as well as the cash burn and understanding what does that mean from a cash flow profile of the business. Capital expenditure is one where I would say typically gets missed around the decision making of companies and understanding the practicalities around certain CapEx. Now, pre-COVID business plans would have assumed a certain CapEx profile built off growth. Clearly, that is potentially discretionary spend and something where they can delay those cash flows, which, you know, from a valuation perspective may increase the value because you can now push those cash flows out further to allow, you know, cash to be retained in the business. Now, the point on capital expenditure is important that can only work for so long, because obviously there's a point of delaying capital expenditure, but also maintaining and keeping up with the competition and making sure that there is no certain impact long term of cutting CapEx. So there is a balance between just completely taking capital expenditure out of the business, but balancing the near-term need of that capital expenditure to then how we may change over time as the business and the revenue profile changes also. So obviously there is a lot of downward arrows here around the business, and obviously CapEx may offset some of that. Now, I should have said at the start that this is obviously not looking at the Amazons of the world or the Apples or the ones who are, you know, the technology ones who are obviously potentially inverse to this. This is more obviously the businesses around retail, you know, oil and gas and other ones where we know that have been impacted the most. So that covered, I guess, the discounted cash flow and the value in use concepts. I move now quickly to the market approach, and this is where I guess a lot of the reliance has changed. I think it's fair to say that if you were using a business plan previously, pre-COVID, and you were robust in your forecasting and your projections, and you understood the various, you know, interrelations between revenue and CapEx and so on, I think that the challenge and where we're seeing a lot more work and effort and support is required is around the scenarios built around that. It's nothing new, but it's around how else can we look at the market, how else can we look at the business, and what are the different scenarios and recovery profiles. When you look at market approach, it's a little bit different, and this is relevant more to your fair value less cost to sell analysis. And I think typically the challenge has been always that you know, it's sometimes a simplified approach, particularly when you have smaller equity investments where information may be restricted. Typically, some people got away with just using historical earnings, historical multiples, you know, FY18 earnings times 7 times, and that's a broad answer. The challenge here is obviously, as I mentioned at the start, earnings have been impacted. So the level of maintainable earnings is in question. What does maintainable net mean now in this environment, as well as the multiples? Can I rely on historical multiples or transactions historically that occurred last year? In our view, particularly on transactions, the answer is no. The market multiples are typically obviously brought out of comparable companies and peer groups. there must be much more diligence now on what does that peer group mean? What's the quality of those peer groups? What is bolstering their share prices, which may not be relevant to my group? The ability to take an average now is obviously less because there's a lot more noise in some of these multiple numbers. So from our perspective, we are trying to make sure we're trying to take post-COVID earnings and post-COVID multiples. And by that, I mean forward multiples, forward earnings as much as you can. And I guess it's not that we cannot use this approach. It's just that more diligence is required around the selection of comps as well as the various aspects going into the inputs. And one of those aspects, I guess, just to cover lastly, is on the share price. You know, a multiple is built up of the share price, the market capitalization that then gets built into an earnings multiple that we then use to come up with the value or fair value less cost to sell. Share price, the volatility that's incurred, obviously can change that multiple very drastically, and understanding what share price you use is the other challenge. So I think I appreciate there was a lot covered there, and apologies for going so quick, but I know we have a panel session shortly and happy to answer any questions. But I guess in summary, from an income approach and a value in use approach, COVID's impacted this in many ways. Discount rates can be broadly said to be increased over time through the different components that is impacted, increased or stayed the same. In terms of the cash flows, there is a real need to now run scenario analysis and understand the different trajectories that may occur. And building that into the cash flows is the important point. And making sure that you are running those robust scenarios and doing that early on in the piece. Otherwise, you know, there is a challenge, but understanding it and linking it back to management decisions is the important piece. Market approach multiples have decreased generally, and I think the use of the market approach is now much more challenging. The simplification of the market approach is dangerous in this environment, and we would recommend, you know, you try and use an income approach as much as you can, just to understand the trajectory of earnings, to get it to a level stage, and then you can maybe use the market approach. And then transaction multiples, we wouldn't recommend using those in this environment. Now, the other aspects, I guess, another input on the valuation of discounts and marketability and control. And these are discounts whether you own a minority interest in a company, or also discounts applying because it's a private company and therefore there's time to sell the company. And typically from an industry perspective, we are seeing you know, the lack of marketability discounts in these environments are typically a little bit higher because of the difficulty to sell assets in this environment. So, you know, for example, if you might have applied a 10% discount for lack of marketability pre-COVID, there is support in this environment that some of those discounts do increase, obviously depending on the certain company and the characteristics, but you know, conceptually that makes sense. As well as premium for control. In this environment, people are paying, you know, would want to pay a higher value for control because of the uncertainty and having the ability to direct operations. So that's another trend we're seeing. So I think that's all from my perspective. Welcome questions through the panel, and hopefully that was useful to the audience. I think, as I said at the start, I think that the key is that the valuation fundamentals haven't changed. It's more around how we adapt and how we use the tools in our tool belt to assess and rationalize the value under various scenarios. Typically, we may look at 2 or 3 different approaches within evaluation pre-COVID and rationalize, and you know, I'm sure many of you have seen football fields of values under different approaches. In this environment where we're doubling, tripling those scenarios to understand the impact, and that's, I guess, the key takeaway. Thank you very much.
Thank you, Scott. And I think we will take the questions in the end. I believe that you will be there towards the end when the Q&A session is there.
Yes, yeah.
Thank you. May I request now Amritji Chopra ji to take over the proceeding and start with his presentation.
Thank you very much. Am I audible?
Yes, sir.
No issues. Let me begin on a very gratitude note to Neeraj, John George, and the entire team for giving the opportunity to share some of my thoughts on this very important topic today. And of course, my very sincere thanks to Ramesh Dave for very generous kind of an introduction. Praful Bhai was there, the past president. My greetings to him, greetings to Umeshji, Vijayji, and all others, basically, and the participants. I know my time limit also for that particular matter. Don't be too worried about it. I know that the panel discussion must run for at least 1 hour. That's the way I am looking at it. See, this going concern concept, we have been reading and reading. Believe me, there have been very few instances where one could find, at least in India, I can tell you. Internationally, there could be many cases where auditors might have a challenge the concept of going concern, which was assumed by the managements. But I can tell you my first impression with regard to going concern came in the year 1985-86. In India, in one of the companies called Modi Spinning and Weaving Mills, I still remember the name of those auditors because that was the first time that I came across that kind of situation. The auditors were Messrs. P.R. Mehra and Company, and they gave a qualification that the management assumes that it is a going concern, but according to us, it's not a going concern. And I virtually wanted to salute that auditor who in 1985, believe me, not today, we are not talking of the trouble times. In good times, one could say that the assumptions of the going concern by the management are erroneous, and the account should not have been prepared on that particular basis. I'm talking of 1985. But this year, probably, the one issue which is going to bother each one of us as auditors and as accountants also, wherever the accountants are there, the professionals are accountants. I think the one issue which is going to bother us all this particular period is whether an organization is a going concern or it's not a going concern. This is the challenge which COVID-19 has brought in its wake to each one of us, for that matter. I just can't think of that under COVID-19, there are certain specific industries. After all, when we talk of the going concern means that where there is no possibility of substantial curtailment of activity or probably of, you can say, closing down the entire operations of the entity in the near foreseeable future. So if that is how I am going to really look at the going concern concept, the point that arises is that under COVID-19, wherein there is a large number of industries. Believe me, I personally feel in India we are more hard pressed than what the people outside India would be as professionals, and that's one thing that I will like to be contradicted if someone can contradict me. Because in India, when we sit on the accounts of 31st March 2020 itself, because abroad probably because the accounting year has been calendar year, and in the calendar year the accounts have already been finalized. So probably the going concern for the accounting year ended 31st December 2019 did not assume that kind of significance, except for probably in the case of China. But in India, the closing is 31st of March. And we are all closing 31st March 2020 today. And when we look at this 2020, the COVID-19 has already set in. There has already been a lockdown basically in the country. And there have been not one lockdown, there have been multiple lockdowns, and in certain states the lockdowns still continue. And if that is the case world over, probably that could be one of the situations to be faced therein also. But when the auditors abroad will go to audit the accounts for the year 31st December 2020, they will have much better information available with them with regard to the impact of COVID. The impact of COVID could have a tempered off, basically, tapered off. But in India, the impact of COVID has actually gained during the last 4 or 5 months. And the auditors are absolutely wary of it, and the accountants are wary of it as to what is to be done. And if I look at it today, you look at the tour operators, you look at the aviation industry, you look at the hotel industry, you look at the entire hospitality sector for that particular matter. I'm unable to perceive basically a situation wherein for the next 4 or 5 months, anybody would be traveling. And I don't think that, why only 4 or 5 months? Because COVID-19 has played a more havoc in the minds rather than physically, if you really ask me. Now, when it is in minds, people are not willing to travel. I have been one of the most frequent travelers within the country for that matter. I have not traveled anywhere in the last 5 months, and I am very sure my family is not going to allow me to travel anywhere else in the next 4 or 5 months, even if the traveling is allowed for that matter. Now, the point that I am trying to drive home is that once the traveling is not taking place, aviation industry is in for a toss. You can be absolutely clear about it. In India, I think we will have to seriously think about it. What do we do to Indigo and some of the surviving airlines, particularly the Air India for that matter? How will the government actually, how much money Air India will be able to get from the government to survive? So I think both in the accounting as well as in the auditing, that's going to be a major challenge so far as the aviation industries are concerned. Similarly, the challenges are going to be there with regard to the tour operators. All small tour operators are going to be wiped out. That's the way I look at it. I don't see any reason that the tour operators will be able to survive if they don't have the wherewithal to survive for that matter. And I will come to some of the characteristics how people may be able to survive in some of the circumstances. Small hotels and small restaurants, it's a major problem to be faced by each one of them. Because in the case of, if the restaurant is closed and you are not allowing anything except for take-home deliveries, I think take-home deliveries also has a limited potential. You just can't have take-home for everything. We have a number of restaurants in Delhi, for that matter, where this is a problem, and I think this problem will be there world over. Continues for a longer time, these restaurants get wiped out. And then the auditors and the accountants of the restaurant will have to really grapple with the situation, whether these are going concerns or these are not the going concerns, because closure could be in the foreseeable future itself. The other thing that one will like to say is that their entertainment industry, the entire cinema halls, at least in India, have been closed down. And if the cinema halls have been closed down and these are not going to open up, and you have the fixed expenses which are running, and unless you expect that immediately after the COVID-19 is over, people will start fogging the cinema halls, it's not going to happen. As I said, it's more on mind than physical. People are going to be absolutely cautious whether they should be going to cinema halls even 4 months after the opening of the cinema halls. And the same has been the case with the malls. Believe me, malls have been opened in certain parts of the country, but ask the shopkeepers whether the people have been visiting them, people have been coming for shopping. I think the answer may be negative. So all these factors taken together, basically, gyms for that matter, I'm going industry like gyms. Gyms is another area which has taken a big hit, if you ask me. People are, firstly, the gyms were closed. Now, even if the gyms have been open, people are not willing to go. because how do you maintain the social distancing there? You may be talking to so many people, and if in places like in some of the places, the area available in the gym may not be that much that you can take care of the social distancing for that matter. So what one is trying to tell you is the situation is terrible. Small insurance companies, look at, and I think this will be world over. If people have taken loss of profit policies or certain other policies with the small insurance companies, and the kind of claims which will be coming to these companies, whether they will be able to survive, I think this is something which may have to be seen in future only. And similarly, some of the smaller banks, I think Vijay is there. Vijay would be able to actually bear me out. Smaller banks world over, they are going to face the problems. There's absolutely no doubt in my mind, because industry is not going to do well. The businesses are not going to do well. Most of the industry, there could be certain businesses which may get revived. If most of the borrowers are not able to pay their monies, smaller banks can't keep on giving the moratorium unless the government support them. And I don't think in the private sector banks, the governments are going to support in those cases. The governments might be able to support the industry in some of the circumstances, but I personally feel so far as the smaller banks are concerned, smaller banks are going to face deeper problems. The level of non-performing assets in all banks is going to go. And I think by one of the assessments in India itself, the moment the moratorium is lifted, basically, probably in September or October, people say that our NPA level could go up by 2 to 3 lakh crores. I think it's not a small figure in any case. And if that is going to happen, I think the banks are itself are going to face the problems. The point that one is trying to make out is, it may be good to say that, yes, there is a possibility of the industry reviving. Yes, one sector which has revived and that's surprising as to how that sector has been able to revive, at least in India, that is the auto sector. Auto sector in the last 2 months has been operating at 85 to 90% of the capacity. Particularly the rural demand of the two-wheelers has picked up like anything. Now, when I go to audit these entities, probably I may be lesser concerned, because the cash flows which might be projected, the projections which the management will be able to give me, I know going by the market reports also, yes, this particular industry is actually picking up. I may be still able to maintain that, yes, there could be material uncertainties, but these organizations or these entities could be still going concerns. But so far as the other entities are concerned, I think there is a major challenge of really finding out whether something is a going concern or is not a going concern. And it will also be affected by, I think, as an auditor, as an accountant, it will be one side, as an auditor, it will be another side. What the industry will have to look at, and what the factors which can influence an organization or an entity to be a going concern or a non-going concern could be, if you have been living on the borrowed money only, and borrowed money is not available at all now, and you have been paying a huge amount of interest and the revenue has fallen substantially, and there's no possibility of reviving this particular revenue in the periods to come. I sometimes wonder, and I would like to get the answer from somebody, whether in US, Spain, Brazil, for that matter, the priority will be to get certain imports from outside countries, or the priority should be the health of the various people, because the kind of situation that they find themselves in is that we need to be very, very cautious of the health of the people, the safety of the people, rather than reviving certain imports, etc. So the point I am trying to make out is, it will all depend upon what kind of money you have been living in. If you have been living on borrowed funds and you have been exporting to all these countries like US or Spain or Brazil, and if the demand there goes down of your product and goes down drastically, in that case, the possibilities of revival could be absolutely minimal. So I think that could be one of the features, that could be one of the factors which will determine ultimately whether an entity would be a going concern or would not be a going concern. Abroad, one thing has been very good, whether it has been UK or Canada or US, the governments have actually supported the industry. The governments have been able to support the industry even in terms of payment of the salaries, which in some of the underdeveloped countries has not happened, or in some of the developing nations has not happened. Now, if the salary has been constituting a major head of the expense of an entity, and the governments have been able to make you dole out the money to make the payment of the salaries, to ensure that there is no unemployment, basically, because if you lay off the people, it creates other social problems also for that matter. And if the government has been able to take care of the industry by making payments directly for the purpose of really helping you out in payment of the salaries, I think it's a very welcome sign, and probably that is one feature that accountant and the auditor would be considering to find out whether it's a real mitigating factor, to find out that this still remains to be a going concern. Another thing is that if your creditors, your bankers, may not be willing to support you at the end of the day. And in India, now one good thing that has been done for the time being is that the Insolvency and Bankruptcy Act proceedings have been kept in abeyance for a period of 1 year, so that no creditor can take you to the court of law, to the tribunal, that's the NCLT, and ask you for the insolvency or the bankruptcy. So this is a very good move. But then at some point of the time, so what will happen is now is banks per force will be required to support you. Because earlier, and even the banker could have come up and said that I will like to file a bankruptcy case against you. But with all this coming in, the banks can't go to IBC. So banks may have to per force restructure the loans, support the industry, and I think this is a good move. And if it will all depend upon world over how it goes on. And if the governments are willing to support, governments are willing to change the laws for that particular matter, I think the going concern concept still could continue to be there in respect of some of the entities. Another very important aspect of COVID-19 is if it affects A, and A is the buyer of the product of B. Now, if A's liquidity is affected adversely, B is automatically going to be impacted, because A will find himself unable to make the payment to B. So it's all interconnected basically. So COVID-19 has its own problems so far as this particular part is concerned. Exchange fluctuations. But if at all there are certain restrictions with regard to the remittances, all these things are going to add to the issues on the going concern for that matter. And one of the things which is going to happen is that the goodwill part will be substantially impaired in respect of many items. So, and if your goodwill is impaired, what happens in that particular case? I don't have to get into that. In India, there have been certain cases where I have leased out the property to somebody. Now, one of the factors could be that there is a force majeure clause, or there could not be a force majeure clause. If there is a force majeure clause, the tenant, the lessee says that I am not supposed to make you payment because I am covered by the force majeure clause under such natural calamities. Now, one of the debates which is going on, and I think that should be the case world over, whether COVID-19 can be considered to be a natural calamity, or it may not be considered to be a natural calamity to attract force majeure, even for that matter. So all those factors are going to really affect the, you can say, the going concern concept. And another point that could be, will be with regard to, you can say, the overall demand in the economy. What kind of product you are manufacturing? As I said, two-wheeler demand has picked up. But if you are manufacturing a kind of product for which there is an elasticity of demand, if the income goes down, your product demand also goes down. I think the going concern gets attracted there faster than in the other cases. Now, the point that sought to be actually addressed is, and for which we are all here today. Number one is that whenever I am trying to find out whether something is a going concern or not, what factors I should be considering, either as an accountant or as an auditor, because the underlying assumption of any account is that an entity is a going concern. And if an entity is not a going concern, then I come into play, basically. Then that disclosure has to be made. If I look at the auditor's report, SA 700, there is a very clear paragraph which has to be given with regard to the material uncertainties on with regard to the going concern. If at all you feel that way, and there could be three kind of situations which may emerge to you. SA 570 as it stands revised today, it very clearly goes on to say one thing, that there could be three kind of situations. Number one, that the management makes a disclosure. They assess whether they are going concern or not. No, they will have their assumptions, they will have their presumptions, they will get into the cash flows. The main important aspect, I think even when Scott was discussing, he was discussing more about the cash flows than anything else. Whether the cash flows could be there, whether it's the net cash inflow or net cash outflow for that particular matter. Now, if there are going to be net cash inflows and the management has projected that and you have actually considered that, but the period that the management has considered, if it is only 6 months, I think you can ask the management that the period should be at least for a period of 1 year rather than being a period of 6 months. But generally your period considered should be the same as the period of the management. But even if I look at the standard does not say that you have to restrict to 1 year. It says that minimum period of 1 year has to be considered. One of the main confusion which is arising in the minds of the most of the professionals is whether it's a period of 1 year, because we say in the near foreseeable future, the projections of 1 year are to be considered, less than 1 year are to be considered, or the projections beyond 1 year can be considered. I will like to say that the standard only talks of a period minimum of 1 year. It does not say what is going to be my maximum period. Because if in the case of a startup, particularly, I consider only a period of 1 year, then most of the startups will become non-going concerns. And then who is going to fund them for that matter? I think we have to be absolutely flexible so far as that particular issue is concerned. But the only thing that I have to make sure is, as an auditor for that matter, and I think that is what 570 very clearly brings out, that I cannot trust only the management representation, whatever the management has said. I will have to actually test their assumptions and presumptions with the industry, with the, I think whatever are the market reports, I can use my own intelligence with regard to the market reports, and then look at the cash flows the way these have been projected. And if I'm satisfied with this, I may say I may not like to comment adversely. I may not rather like to even add a para. But if I don't want to add a para here, but if I want to make it a emphasis of matter, I may still be able to make it an emphasis of matter under 705 for that matter. The other thing that this particular standard very clearly brings out is, suppose the management gives certain assumption, presumption, management comes to a conclusion that it's a going concern. Now I have to conclude, I have to gather that particular audit evidence, because audit evidence in any case is going to be very important in these cases. COVID-19 is going to teach us one thing at least, that I am clear, how to document the concept of the going concern, whether an entity is a going concern or not. How do I really look at it, and how do I satisfy myself? How do I conclude that whatever the management has said that it is a going concern? Now, if the management says it's a going concern, and I do not agree with them, not the extent to which I don't agree with them, I think that's going to be very important. It could lead to a qualified report, and it could lead to an adverse opinion also in certain circumstances. The other thing would be that the management does not make any disclosure. One assumption is that it makes a disclosure, and then I am not satisfied with whatever findings they are having. The other thing is that the management does not make any disclosure, and despite my telling that make a disclosure whether you are a going concern or you are not a going concern, I think I can give a qualified opinion or I can give an adverse opinion depending upon the circumstances for that matter. If I am coming to a conclusion, yes, probably this entity may not be able to continue in future. Suppose a creditor has already filed a suit, and in that particular case, a creditor has already filed a suit in the court of law, and there is absolutely no escape route. I cannot make the payment. The banks are not willing to support me. The government is not willing to support me. In that particular case, it becomes a non-going concern. And if the management is assuming it to be a going concern, you can definitely give an adverse opinion in those circumstances. The point that I'm trying to make out is going concern is not going to be that easy, very frankly. There could be cases I will have to study even in the impact of if there is a parent company and I'm auditing a subsidiary company for that matter. And if the subsidiary company has got a comfort letter from the parent company, that parent company will be able to infuse the funds in case of the difficulty. I think I can definitely consider that to be a mitigating factor. The government support can be considered to be a mitigating factor in most of the circumstances. So, and if at all there are certain guarantees by the counterparties also, I think that can also be considered to be a mitigating factor in the circumstances. But all those factors will have to be factored in. I will not be able to ignore any of the factors. But if at the same time, I have got a comfort letter from the, you can say, the parent company. Parent company itself is in doldrums. Parent company's own net worth is already lost. What kind of a comfort letter is it? And these kind of comfort letters will get in plenty. That you can be rest assured about it. And I, having been in practice, one has been able to see in certain other fields also these kind of things happening. So one will like to say that there could be cases where the managements are making disclosures, managements are not making disclosures. If they make disclosure, study those disclosures in relation to the various mitigating factors and in relation to the projections that they have actually given to you. And if they have not made the disclosure in any case, then you have to study. And if at all you find that it is not going to be a going concern, you will have to definitely say that you will have to give an adverse opinion. Last point that I will like to say is, giving something in CAM is not a substitute to a paragraph or material uncertainty in the report. If something has been mentioned in CAM as a key audit matter, that is not a substitute for the paragraph of material uncertainty in the main auditor's report under SA 700. I think that is one thing that I will like to be very clear about. And lastly, that I will say is, this is an area which is going to be the grayest possible area beyond under COVID-19. And I think it's a nightmare both for the accountants as well as the auditors in the periods to come. I stop here, and if at all there will be any questions, one will like to answer those out. Thank you very much.
Thank you so much, Amritji Chopraji, for wonderful insight on the going concern. I would like to now invite our committee member, CA Rameshji Dave, to introduce the rest of the speaker and start with before starting with the roundtable or panel discussion. Over to you, Rameshji.
Thank you, Ajayji. And thank you, sir, for your wonderful thoughts on going concern. Very, very honored and happy to hear you. So we have another luminary of speakers now. So we have CA Vijay Kumar MPG, who has over 27 years of professional experience. He is currently a council member of ICAI for the period of 2016 to 2022. Vijay Kumarji's profile is also full of achievements and rich experience, but I will be brief in introducing him. He is the chairman to various boards like accounting standard boards, valuation standard boards, digital accounting assurance board. He is the vice chairman and nominee member of various committees like expert advisory committee, member of auditing and assurance standard board, board of studies, corporate laws and corporate governance committees, ethical standard board, and member of various management and executive committees. Vijay Kumarji is currently working as CFO at SIFI and earlier been a partner of Yoganand and Ram LLP. He has also been the head of investment banking at Sundaram Finance. Mr. Vijay Kumar holds directorship at various corporate houses in India. He has also been awarded CFO India Award and 100 Most Influenced CFO in India Award by Chartered Institute of Management Accountants, CIMA. We welcome you, sir, for accepting our invite to participate as a panelist for IFRS Virtual Conclave Going Concern and IAS 36 Impairment of Assets to address our fraternity members. We also have CA Umesh, who will be the moderator for this panel. Mr. Umesh is Director of Leading Assurance Practice in CROE in the Emirates of Abu Dhabi. Umesh has a rich experience of over 18 years in handling audit and assurance engagements of diverse portfolio of multinational listed companies. He is also specialized in assisting entities with the implementation of new IFRS standards, establishment of internal control frameworks, and risk management. Mr. Umesh is also a member of Core Advisory Committee on Independence to the Global Audit Committee of CROE. He is also leading various initiatives on smart audit documentation and automation of audit processes at CROE. Umesh also leads the in-country value program in CROE. So we thank Umesh for joining us and being the moderator for this panel. We would once again like to welcome Sri Amarjeet ji, Sri MP Vijay Kumar, Mr. Scott, and Umesh for our next session. Thank you.
Just 1 minute before Umesh starts, basically, with regard to Vijay, I would like to say just one line. He is the pride of profession from our side. That's all I will say about it. I will only like to say this.
So deeply humbled, sir. Thank you.
Okay. Thank you all. Thanks, Ramesh. Just before we start, Neeraj bhai, how much time we have? Are we running online or? We are not able to hear you, sir.
Yeah, we are a little short of time, no doubt about it. But I think maybe around 40 minutes
panel
discussion and then 10-15 minutes Q&A we can do.
Then I don't think any audience would be bothered to see the time when we have such a great panelist.
Probably yes. Yeah, true.
Okay.
You're right.
Okay.
Right. Thank you.
Let me start with a quick expression of gratitude. Thanks to ICA Abu Dhabi chapter. Special thanks to our favorite chairman, CA Neeraj Ritolia, for giving this opportunity. It would be greatest privilege for me to be part of a panel having such a eminent legendary speakers. We have speakers, past president of ICA, CA Amarjeet Chopra sir, chairman of Accounting Standard Board, CA MP Vijay Kumar, and valuation specialist partner from Deloitte Middle East, Scott Wallen. I think we got the best of the experts in the panel. I'm sure that the participants are going to witness yet another wonderful session with a lot of key learnings to take away. Without any further ado, let's go to the panelists. With the permission of all panelists, I would like to open the discussion with CA MP Vijay Kumar sir. Sir, actually, I was your student when I was doing my CA, and of course, I got the best of my marks in those subjects. I would like to sincerely thank you for your coaching, mentoring, guidance to tons of professionals, and invaluable contribution to the professional fraternity. You are a great institution of knowledge. Thank you very much, sir. Now I would like to go to the topic of discussion on IAS 36. We all know that the IAS 36 impairment of asset is one of the most interesting standard, but it has a lot of complication in terms of application compliance. On top of that, COVID has added its own peculiar challenge. So, and many of the companies now have a trigger for impairment. How industry is tackling this impairment accounting in the current situation, and how auditors should manage the risk, sir? So over to you.
Yeah, thanks, Sumesh, for those kind words. And thanks to Mr. Ramesh Dave for the introduction. I'm deeply humbled by the very, very kind words of a doyen of our profession, Amarjeet Chopra ji. In fact, it's been a huge learning experience for me, particularly in the last 4.5 years, where he was chairing NACAS and I had an opportunity to attend as an invitee, and subsequently in the various boards or committees where he has been so kind enough to give time. It's been a pleasure to learn the way he conducts meetings and the way he contributes. So thank you, sir. And thanks to the Abu Dhabi chapter for the invitation here, sincerely obliged. And I think between all of you, Abbas and all, you've been doing an outstanding job. And it was pleasure listening to Scott and the past president, both Praful ji as well as Chopra ji. It was pleasure listening to all of them. A lot of insights. Let me come to this question. Let me open up with some fundamentals. In fact, my own personal view is that once there is a good understanding of fundamentals, compliance automatically comes. Compliance automatically comes. Many hesitate to comply because of lack of understanding of the rationale. So typically, if one were to look at any entity's financial health, it is determined by the quality of assets the organization has. So assets basically are the future economic value of what you have, future economic value of what you have. And if you look at your assets, if I were to come from the bottom, from current to non-current, so if you were to take receivables, they're all carried at gross value less impairment. So you carry it at a realizable value. When it comes to inventory, again, it's carried at realizable value. When it comes to investments, depending on which category of investments, FATPL, OCI, or the amortized cost, they, in a sense, all of them have fairly strong impairment provisions. So if you look at all of these assets, the concept of impairment is so well ingrained into the way those assets are carried in the balance sheet. So excluding these assets, the largest asset for most organizations, particularly those in manufacturing organizations, is the non-current assets. And if you look at non-current assets at a conceptual level, property, plant, equipment, factories, manufacturing plants and all. Whenever an enterprise decides to set up a manufacturing plant, whenever an enterprise decides to set up a project, the decision of putting up that project is based on the present value of projected cash flows of that project. So whether it is bankers who lend tons of money to fund a project, or even large institutional equity investors who largely follow, and I'm sure Scott will bail me out, largely follow DCF approach. So typically the project viabilities are based on the projected cash flows and from which you arrive at the present value. So if the present value of that particular project, projected cash flows is $100 million, where it implies that this project is worth investing up to $100 million. You can invest 90, 95, 98, 100 million and not more than that. That's how the capital budgeting decision is taken. So having decided to invest in a project, manufacturing plant, setting up a new capacity, based on projected cash flows, and you have raised resources based on those projected cash flows, be it in the form of debt or in the form of equity from institutional investors or otherwise, over the project life cycle, if those cash flows undergo a change, like the current period of COVID impact which we are seeing, where your capacity utilizations are likely to be less. Scott took us through a few nice slides which explained which are the industries, how they are getting impacted and all. And also given the fact that I was sharing this in a different context a few days back, if I were to take an economy like India itself, the GDP is expected to be lower by 10%, which means 30 lakh crores is going to get shaved off. And if you look at globally as well, almost about $13 trillion of economy is going to shrink globally. And I was very surprised to see the Q2 information of US. Q2 GDP versus the last year Q2, almost 32% drop in the GDP. With this kind of an impact, and so much of uncertainty around, the original projected cash flows are unlikely to be there now. So the projected cash flows now are most likely going to be lesser than what you have initially estimated, which means the present value of what you are likely to derive from the continued use of the asset is less. And it is only a faithful representation that if the non-current assets carrying amount is $100 million and my expected recoverable amount is $70 million, I have to faithfully represent that, look, I am likely to recover only $70 million. And that $30 million, I need to write it down. And that write down is impairment. And this particular standard, like Chopraji talked in the context of going concern, in our career spanning across 3 decades and for him about 4 decades, maybe there were 2-3 occasions where we had opportunity to apply the impairment standards. May not be the going concern concept, but I was pleasantly happy to hear the Modi spinning mills example in 1981 itself. But the impairment standard, the usage of it is likely to be substantial now. And if entities do not test their cash generating units or their assets for impairment and consequently defer such recognition, they will be only ending up with a substantial shock later. What could be smaller now? In fact, it could be smaller for a small positive sign that the interest rates have come down a little. But as Scott walked us through, the premium on equity risk, etc., have gone up, more or less offsetting, or maybe it's gone up a little higher also. So if it's higher than what is the past, you actually have a double whammy. So cash flows are less and your discount rate has also gone up, which means you literally have a double whammy hitting you. And that kind of an impairment is something which organizations cannot escape. And the standard so beautifully recognizes that, look, here is an opportunity for you to assess whether you want to recover your value by continuing to use the asset as is, or explore an opportunity of an exit, which is the fair value less cost to sell. So the higher of these two is recognized as the recoverable amount, which you compare with carrying amount and then recognize impairment. I just want to highlight one very, very important element with reference to impairment. In the context of IAS 36 and intangibles, IAS 38 read together. For intangibles which have an indefinite life, like goodwill, and those intangibles which are yet to be put to use, the standards rightly require an annual test of impairment. That annual test need not coincide with the reporting date. So most organizations, as part of the workload planning, if I were to take an India situation where accounting year is 31st March, many organizations prefer to finish this annual impairment cycle test around 1st February or 1st March, take some cutoff date like that. So what the standard says is, look, even though you might have done it 2 months back, even though you could have done it 3 months back as part of your annual impairment cycle, which should have been okay in a normal situation, because of the COVID and the fact that within this 1 month or 2 months, fundamental assumptions have changed, you have to once again go through the process of testing the goodwill and those intangibles for impairment. So These are some opening remarks I thought I will share with you.
Thank you, sir. I think there were a lot of key messages. I think you've given extensive guidance on how professionals should carefully understand the situation to be in compliant to the accounting standard. There are a lot of further things to discuss on this hot topic, and this is a great opportunity to directly hear from the chairman of the Accounting Standard Board of India. So we'll come back to you very shortly. Next,
Sure.
I would like to go
Umesh,
to
Umesh, with your permission, I missed to make this disclaimer.
Yes, sir.
Just for the benefit of all the audience. Normally, if I ever had to have a slide deck, I would have said, whatever views I'm communicating, all of them are my individual views as a professional. None of the views here should be seen as views of the institute, the council, or the accounting standard board, or any of the boards I represent. It just gives me that extra freedom to share the views from a practical perspective.
No, Vijay, don't mind. He only said views of the chairman of the ASP. He never said these are the views of the ICI. Don't worry about it.
Thank you, sir. Thank you. Very well noted. Yeah. Now, I would like to go to our past president of ICI, CA Amarjit Chopra, sir. I think Chopra, sir, is one of the great inspirational leader, and he always led from forefront on new topics, expressing his views, providing suggestion and guidance to professionals. I think he's one of the pillars for the profession. There's hardly anyone in the professional fraternity who doesn't know the name C. Amarjit Chopra. I think he's a great inspiration to young professionals. I think it's very difficult to define what is young. Age is just a number. Learning is a constant and never-ending process. I think audience would be thinking what's happening in the finance conference, talking about age, but okay, let's quickly go back to the topic. So I would like to go to the going concern. I think you expressed and covered everything related to going concern. I would like to elaborate more on some of the topic. We know that COVID-19 pandemic has caused unprecedented turmoil in the global economy and financial market. The breadth and the duration of which still remains unknown. Companies' projections are affected. There's a disruption to the supply chain. There's a shift in the demand of products and services. There's a loss to the key customers. There are a lot of other factors. Majority of the segments, as you said, are going through severe bumpy ride. Many of the countries are expecting negative GDP growth. When we have so much of uncertainty, how companies are factoring various information in establishing the going concern assumption while preparing a financial reporting. So over to you.
Thank you, Umesh. I think a very complex question, but one will like to answer it in a straight manner if you ask me. See, as Vijay said that in the last 4 decades, there could be hardly 3 or 4 occasions somewhere. I tell you, this has been the bane of the entire problem in the corporate sector, if you really ask me. And that is why the people have rushed to and we have an NPA level of more than 11 lakh crores, which is declared level, mind it. And equal amount of undeclared level is also there. Now, if people had actually made out whether we are a going concern or not, it would have been much better, because ultimately then you have to have liquidation value of the assets and liabilities. When people know that you are going to be liquidated, people don't pay you as much as you may be thinking. And you also don't pay to the people as much as you have to pay. That's also a matter of fact. After all those people who have gone to IBC, that's the Insolvency Bankruptcy Court, I can share with the people sitting over here, average haircut that the bank is taking is 70%, mind it. Average haircut is 70%. A company like Alok Industries, banks took a haircut of 83%, mind it. And the first case which came up in Hyderabad, the banks had the haircut of 94%. Now you tell me a company which had to give this kind of an haircut to the bankers, could have been considered to be a going concern under any circumstances. I fail to understand that. Or a low industries could have been considered to be a going concern in those circumstances. I fail to understand that. No, which means that the managements kept on making certain projections irrespective of the COVID-19. Forget COVID-19. COVID-19 has come now. Even when the things were good, people could not make out what is happening basically. And whether the return will be coming or it will not be coming, whether a company will be a going concern or it will be dying out very fast, and the banks will have to take that kind of haircut. Now, under COVID-19, our problem has become more complex. And that is where the interim financial results, that's the way I look at it. These may change quarter to quarter because the assumptions of the management may have to change from quarter to quarter. Because one quarter, a management may feel, yes, we will be able to do better in the next 1 year. And then you realize, no, you will not be able to do better because certain things have happened abroad or within the economy, which will force you to think otherwise. I think interim financial results are going to see a lot of volatility if genuinely, if one has to feel about it. So far as the, you can say annual reports are concerned, I think Mubin has raised one issue that I would like to cover right now. He has already given one question in the chat box, in the question answer box. He has asked me that if abroad, where the closing was 31st December and somebody is closing in August 2020, December 2019, we are closing in 2020 August, whether you need to consider it as an adjusting event. I think the standard is very clear. IAS is very clear, IAS 10. You can't consider it to be, except in China, where COVID-19 had arrived. In the other cases, I don't think it will be possible to consider. Yes, in the interim financial result, you will be considering it because internationally, if somewhere it had come in January, somewhere in February, somewhere in March, etc., probably in all interim financial results, you will be considering the impact thereof. But to my mind, despite whatever huge impact it might have, you will not be able to consider it to be an adjusting event unless there is a carve out so far as IAS 10 is concerned. So I'm clear so far as that particular part is concerned. Coming back to the question which Umesh has raised, I will only like to say that as an auditor, I will have to play it because I think Abbas said to begin with that the concept of prudence is coming in. Whereas normally in the IFRS, we used to say that the concept of prudence can be given a go by. But I think prudence is coming back. If prudence is coming back, I think I have to be very, very prudent in choosing any accounting policy, in making my projections, in making the predictions and making my assumptions. I personally feel if at all, I feel you take the case of the deferred tax asset from that angle. If I personally feel that the company may not be doing well in the subsequent periods, I may like to reverse any deferred tax asset which has been created. So from the angle of the going concern, I think my documentation, my audit evidence, my calculations have to be very, very strong and very, very prudent. Because COVID-19 is not going to die out so far as its impact is concerned. It's going to, the situation is going to deteriorate. That's the way I look at it. I think in our, in most of the industries, unless the government support actually comes in. If the government is committed to support you, fine, absolutely no issue. If the government is not committed to support you, the government only tells the bankers that you give a top-up loan to somebody. You may give a top-up loan to somebody, but the interest has to be serviced by the gentleman at the end of the day. How does it do it? Unless the revenue built up is there or something else is there, you need to support the industry by either interest cuts, waiver of interest, or concessional rates of interest. You just can't say that you will top up the loans and then you can avail it, but interest will have to be paid by you. I think moratoriums for payments for one year or 2 years are not going to help. Ultimately, that amount will be payable, and you don't know whether a particular demand will be created in the next 1 year or in the next 2 years or not. I think the long-term impact, the long-term assessment of the demand in respect of the various industries will have to be checked out. Abbas was talking that the stock markets have actually gone down internationally. In India, the stock markets are moving. It's the other way around, because either these are bears or these are bulls which are controlling the stock market. So the shares are going up. One day the share goes down by 150 rupees. The other day, the next day, the share goes up by 250 rupees. The same share. I don't know on what basis it operates. So my humble request to you is, to everybody, this going concern is a tricky subject. Let me be very clear about it. It may not be very easy for us also to come to a conclusion that it is not a going concern. And I think there are going to be mitigating factors that I have talked of. There are going to be other factors which will have to be considered. And it has to be beyond a period of 1 year. I think you will not be able to gauge the going concern concept with the figures of the next 6 months or next 1 year. You may have to look at the industry much beyond that, the demand much beyond that. And as I said, that auto industry, I always thought is going to die out. Auto industry has come up back very, very strongly in India, for that matter. And if the government decides, I will give you another example. Today, cement industry is not doing well. Steel industry is not doing well in India. But if the government decides that they have to make a huge infrastructure investment, huge means huge at the cost of the deficit financing, I think the industry is back. After all, you will require cement and steel both for that particular purpose. So I think the factors are going to be multiple. And of course, the audit or the evidence will have to be collected. The assumptions will have to be tested. That's very, very important.
Thank you, sir. I think that was really well explained, and it was very comprehensive. It had a lot of provoking thoughts to be carried forward. I think the auditor should really exercise their professional skepticism and design well-structured risk management procedure to address the risk. So we'll come back to you very shortly. Now I would like to go to our valuation specialist partner, Scott Wallen from Deloitte Middle East. I always consider the valuation expert role as very exciting. People love to listen to them. I think these guys bring a lot of value addition, new perspectives to the table. And I think that was so evident in the presentation. The presentation was so excellent, covered many interesting things on market, industry, various other factors. Thank you so much, Scott. I'm sure attendees have really loved it. Scott, I would like to continue to hear your views on the development and market trends on the impairment accounting. Basically, from the market studies, it shows that oil and gas sector seems to be the only sector that has taken impairment to date. Why haven't we seen impairment accounting in other sector? And which sector do you anticipate the next to be affected? Over to you, Scott. Thank you.
Yeah, Ramesh, very kind words. And I do hope people enjoyed the presentation. You're right. I think there has been very little impairments been recognized to date. Oil and gas has, from our research, oil and gas has seemed to be the one of the key industries that some of the more prominent companies are recording impairments. I think reasons for this are generally that obviously oil and gas sector is extremely sensitive, and the valuation of these assets is extremely sensitive to the commodity price. And it's very real and live and very easy to feature that into the cash flow modeling and understand the impact on value. And given the shocks to the price, I guess there's more confidence from entities, auditors, and management teams to be able to understand the impact on recoverable value through the changes in price. I think when we consider other industries, there has been triggers for impairment. So it's not that other impairments we don't. Obviously, I think it's pretty clear to say that we do expect impairments to come. Triggers have been raised. Industries that we would say that are probably being looked at very carefully, and where a lot of our work has been, is across obviously the retail and hotel tourism sectors in the Middle East and in UAE, obviously, big key driver of a lot of businesses, a lot of family wealth and so on. aviation, for all the factors that the speakers have spoke about. You know, if you think about the retail sector, a lot of value was paid for key money, leasehold improvements. Historically, all these factors are obviously being changed, and the levels of key money in the sector is obviously being turned on its head from a couple of years ago. So I think, you know, the sectors that, you know, are at risk are the ones who have dropped the most in the share price, I think is fair to say. I think if Deloitte did look back in 2008 to understand, you know, what happened back then around the share price drops, and looking back at the 2008 financial crisis, what was clear from that was that there was a very clear lag and almost a very clear correlation between the share price drop and the lag of impairments coming through the financial statements. And that lag has typically been 6 to 12 months around what I mean by that is share price dropping, let's say in January, and you know, and then obviously the 6 to 12 months later is when the impairments were starting to flow through those financial statements for those companies. Why is that lag? From my perspective, I think it would be due to the ability, I think from all the points we've all discussed today around the confidence and understanding the market. I mean, the key challenge we all have is to be able to gain confidence in that recoverable value calculation. And that, you know, we all know what it was like in March and April to understand what the impact was going to be in May, June, July. It was very much everyone scratching their head and understanding what was going to happen. And I think that the unwind and the settlement of the market and understanding the new norm and the new forward-looking position of each business to really be able to quantify that and take comfort, particularly taking impairments, which may be irreversible, such as in goodwill, takes time to unwind into management planning, business plans, and then obviously take that impact in the financials. And that was the case in 2008, the general lag of that, and I think that will be similar now. The challenge is we are probably now, if you look at February, March, we are probably 1 or 2 years, we are getting to that period soon. So that's where the challenge will be, is now it's up to management, auditors and so on to come up with those robust projections, because I think this is the time where some of the impairments will have to start coming through, and you know, we are getting to new norm. There is a bit of a settlement in some of the positions, and you know, we have to now factor that into the financial statement. So I think, I guess it's a long answer to say, I think the key answers the key industries would be the ones that have fallen the most in terms of the share price, particularly in the region where it's so driven by tourism. But I think there will be a natural lag in terms of when these impairments will start showing into the financial statements.
Good. I think Chopra also explained various industries that are prone to this impairment issue. I think it's just a matter of time. Once the Q2, Q3 and the year-end results are out, we could be more evidently able to see how the industries have accounted for this. Thanks, Scott.
Just to add, sorry, that's the challenge of using real live historical financials in valuations because of the lag, and as I explained in the presentation. So it's that awareness that you must think about. So there's not, it's sort of almost common sense, but people don't actually think of the natural lag into some of these financial statements, and that's the important point.
Okay, thanks, Scott. I would like to go back to MP Vijay Kumar sir to continue with the discussion what we were having on the impairment. So there is one topic that finds a lot of interesting conversation in the current situation. That's the impact of IAS 36 and IFRS 16, a newly introduced standard on leases. How this, the discussion is broadly, the standard came new in the last year. People put a lot of effort to understand. Now, the current situation seems to have significant adverse impact on the financial reporting due to the current situation. Would you like to throw some lights on this, sir?
Sure, Umesh. As far as the standard is concerned, as all of us know, it's one financial year old. We are in the second financial year of the standard. And the standard has a concept in the context of lessees where you have a single method of accounting where you recognize the right of use asset and the lease liability. So right of use asset is part of your overall non-current assets portfolio, So when the impairment test is done, those non-current, the right to use assets, the right of use assets should be included as part of the respective cash generating unit, except in those cases where the right of use asset individually generates cash flows, but most likely this would be part of the overall non-current assets. And like any other non-current assets, they should also go through the same process of estimating the cash flows for the entire CGU, arrive at your value in use, and then test for impairment, if any. It appears on the face of it that your asset base is high. It appears on the face of it that the asset base is high because right of use assets have been included as part of your total non-current assets. But what is also important to recognize is when you measure your cash generations as well, it gets automatically adjusted. It automatically gets adjusted in the form of a non-cash expense accounting as depreciation. So it gets accounted separately that way, and it evens out. So it is, people have to apply it for the first time, but I don't see any difference in impairment testing for a right of use asset versus the other assets. I don't expect that. Of course, it looks on the face of it that it is a fairly large base of assets. Your overall value in use is likely to remain same, and the impairment loss amount could look bigger, but it really will not be so when you apply the arithmetics. I've had an opportunity of looking at a few of the companies who had done that impairment test, and I didn't find any difference between a scenario where you were accounting leases earlier as per 17 versus now 116. That's my view on this. As far as lessors are concerned, no change. It would be IFRS 9 which would apply for the lease receivables in terms of measuring for impairment.
Thank you, sir. I think we are running out of time. Maybe I'll go for one quick round of one more question to each of the panelists. A kind of quick rapid fire question of 2 minutes that can be spent by each panelist. First, I would like to go to Amarjit Chopra, sir. So you explained that the auditor should carefully evaluate the impact and the audit opinion, all those things. But it looks like there is increased tendency for the auditor to draw a note in the audit opinion relating to going concern. It could be CAM or it could be in emphasis. In all the cases, whether they gain a adequate comfort, or they don't gain a comfort. How do you see, what do you see with this approach of the auditor, sir?
Majid, I really feel concerned, very frankly. It's as good as most of us tell the companies that if something is not to be shown as a liability, show it as a contingent liability. Let me be very honest about it. And companies also don't mind showing certain things that contingent liabilities, forgetting that even if I show something as a contingent liability, it has an adverse impact on the reader of the financial statements. If certain court case is there, which is running into millions and millions of dollars, which I'm bound to win under any circumstances, and I keep on, and I have the track record that I have been winning all those cases all the times without losing even a single case. And I think my standard is very clear. It says that if there is no possibility of outflow of economic resources in future, you need not even show it in it as a contingent liability in some of the circumstances. No, it is as good here. The auditor wants to be overprotective about things. Well, I think if I have the confidence, have the self-confidence in myself, and I have come to a conclusion based upon the management assumption which I have gone through their predictions, that there is no material uncertainty which is existing basically, why should I get into the CAM or emphasis of matter in that particular case? I personally feel everyone is trying to be protecting. The reason being probably the regulators have become more hyper these days. If you ask me, some of the regulators are playing their role as if it's a T20 match between the auditors and themselves. I don't think that's the kind of situation that we have to be in any case. But I personally feel, if I'm the auditor, and I can tell you I have done it in few of the cases, not on going concern, at least on contingent liability, where I felt that nothing is going to fructify and there's going to be no outflow of economic resources. I told them it need not be shown as a contingent liability also. But COVID-19 is going to be a challenge, believe me. COVID-19 is throwing out so many material uncertainties. I will not like auditors to risk in these circumstances. But in the normal circumstances, I would like to go it with you that auditors need to have the courage, and I think he has to have a courage of conviction. If I'm doing a professional job, in that case, my professionalism also expects me to really not only play safe, to be with the other side also. If there is no material uncertainty arising, why should I keep on writing material uncertainty? Of course, whenever we predict, whenever we go and get into the future projection, some kind of a risk element would always be there. There is no doubt. But there is a difference between a risk and a material uncertainty. I think these two things have also to be distinguished. Material uncertainty is a very, very strong word, if you ask me. And I think I don't expect the auditor to get into this all the time if one is actually convinced to do management.
Agree, sir. I think auditors have to carefully exercise their duty and ensure that whatever required from the standard to be done. Next, I would like to go to Scott. I think there are a lot of learnings to take away from your presentation, Scott. In fact, I had a lot of rapid fire questions for you. Unfortunately, we do not have much time. Only one common question, Scott, that's been discussed, raised by various companies. What is the right timing of doing evaluation? Business plan projection, should I do it now or should I do it at the year end? Should I do it close to the date of financial statement? When do I need to do it, Scott?
Yeah, it's a fair question. And I think my view on this is that this should not be viewed as an accounting exercise. And maybe it's controversial given the forum I'm in, but it's more of a business planning exercise. It's not you shouldn't be in a position where you're pulling together a spreadsheet, a business plan, running scenarios as you're trying to finalize numbers 1 week before trying to quantify impairments. It's not the environment for that. I know that happens by virtue of we're all busy and that's the way, you know, the pressures are under, but the short answer to that is we should start now. There are known elements that we all know that we've seen happen, subsidies from governments, things like that, where we have a bit more visibility. And there's known unknowns as well. And running those scenarios takes time. And I think the model will never be right the first time. The business plan will always evolve as the environment is evolving. But the more you get into the analysis, the more robust it will be at the time where we have to quantify either going concern issues or impairment issues. And I think the thinking behind that model is the important point, not having the business plan ticked off. It's actually understanding all the various elements I discussed before around impact on receivables, anything around you know, CapEx, pushing out that further. So it's started now and build it out as it goes, because I think the scenarios will develop as the economy develops, as the business recovers, and so on. And new analysis will be, but I think it's important to look at it from a business planning perspective rather than satisfying accounting recording on a certain date because I need to have the number by December. I think if they approach it that way, then I think that'll help them have the stories and have the rationalization when it's needed at the reporting dates.
Thanks, Scott. Thank you very much. The last question I would like to go to MP Vijay Kumar sir. He was my guru too. So the last question basically on the impairment. The one which I want to check is, In 2008, we saw a lot of companies wrote down the goodwill. Majority of the US and Asian entities have wiped off the goodwill from their balance sheet. Do you see that kind of pattern that's going to repeat in 2020? And how do you see that kind of impact on the financial is going to, that kind of increase in the financial impact in the long run?
In fact, the answer to that is actually in Scott's presentation. In fact, if you look at one of his slides, he talked about goodwill as a proportion of the total assets, which on an average was about 10%. There's some jurisdictions where it was 16% or some sectors where it was mid-teens or little higher teens. And if you look at the composition of goodwill within the non-current assets, assuming that non-current assets are half of the total balance sheet, whatever number which Scott had showed in that slide would actually be about 20% of your, almost twice your total non-current assets, that 20% or 30%. So it's a fairly substantial number which is there. So I do expect a significant amount of goodwill impairment to happen during this period. And also many of the other intangibles also getting impacted significantly. There are many intangibles which have which don't have a finite life. All of them are likely to take a significant hit as well during this period, and rightly so. The only drawback as far as the industry is concerned when it comes to goodwill, once written off, it's written off forever. So from the industry perspective, it impacts that way. But let me state that I'm going a little outside the jurisdiction, but I want to state that there are many who have been asking for, can there be a temporary pause for application of some of these standards, temporary pause on testing for impairment given the exceptional times. There are also recommendations like lockdown, etc. are driven by government decisions and not management-led decisions. So can we have some kind of exceptions in applying these standards? In fact, if there is any time when you have to actually apply the standards more rigidly, it is now. It is now. When things are looking nicely, a little bit of aberration, few basis points this way, that way, it doesn't matter. It's like when I'm not keeping well, when I'm not healthy, at that time, the doctor's diagnosis has to be more accurate than ever. When I'm doing well and I go for a general medical checkup, some aberration really doesn't matter. But when it's not doing well and when the environment is not good, at that time, the testing has to be fairly accurate. And if I have to so probably state the truth, only if I state the truth, I will get capital support. And my strong recommendation to managements and organizations, today institutional investors and bankers are very, very well informed people. And if you are able to present financial statements where you actually capture the true health of financial statements, you will have quality investors and lenders who will actually be willing to walk with the organizations and help the revival of the business. So goodwill will certainly get impacted, and we will see equal or probably much larger amount than what we saw in 2008, 2009. So that period probably was for some economies. For example, India was insulated from 2008-9 global financial crisis largely. But this COVID has not left, whether large country, small country, developed, emerging, developing, it has not left anyone. And consequently, impact will be pretty huge.
Thank you so much, sir. I think thanks to all the panelists, and it was the greatest privilege of interacting with the greatest speakers. I think, Ajayji.
Yeah, thank you so much. Sincere gratitude to all the speakers, panelists, moderators, and to gracing this occasion and sharing their opinion. I'm sure a lot of takeaways from today's webinar, and members have gained a lot from today's webinar. We will take a 2 or 3 questions because we are running short of time. First question is to Scott. Member Arunachalam has raised it in determining terminal values under the current circumstances. How difficult it will be, and what extra cautions should be taken because of uncertainty?
I guess terminal value doesn't, the difficulty goes to the broader valuation. I don't think terminal value is any more difficult than it is in normal terms. I think it's the path to terminal value is the difficult point. I think there's the first check is because terminal value is obviously the point around perpetual and going concern position of the business. Now we've heard around the going concern consideration. So that's before one gets into a model and assumes a normal discounted cash flow analysis, that should be checked around the going concern point. Now, what other questions to ask? It's around the going concern point. It's the wider economic fundamentals and starting at that macro level and working down towards the broader industry. There needs to be a lot more care around the wider macro and industry outlooks rather than in history. I think we just assumed the ongoing trend continued. So going through that cycle is important. I think the other point to make is also the timing of that terminal value, and not being a typical mistake we see is using 5 years because 5 years was in the textbook. The important point is to apply the terminal value at a point in time when you think the business and the industry has reached stability and you can with confidence then forecast into perpetuity. Don't assume a 5-year cash flow because you have to, because at that point in time the recovery could be still happening in your cash flow profile. So being flexible around running terminal value scenarios, both in terms of the growth rates as well as the timing of those, is another consideration.
Okay, thank you so much. The next question is to CA Amritji Chopra. It's a very typical type of question, like members is asking that we are still in December 2019 audit report has not been signed. And he's asking like whether outbreak of COVID-19 would require an adjusting event that will affect the asset valuation as of December 2019. What are
this is a question asked by Mobin, which I have already answered.
Yeah, he answered, yes.
I've already answered.
Okay.
Next question.
So next question is like member is asking like the COVID-19 impact is due to the government imposed lockdown. Will standard accounting bodies and international countries absorb those losses and give exemptions as an exceptional situation as one of two consideration and let the market to decide? As any one of the panelists can take this one.
I think MPV answered this question that under COVID-19, probably the accounting standard need to be or auditing standard need to be more stringently followed than at any other point of time. Because if we relax the conditions right now, probably there could be a bomb blast later on. We don't need to leave a situation which is, and then we sit on a dynamite, basically. I don't think that should be there. If some of the regulators can do certain things, let them try to do it. I think what is more important for the governments is to give a financial support to the industry. Whether it is in the form of the salary cost, or it is in the form of the aid, or incurring huge expenditure on the infrastructure, or doing something that giving certain kind of subsidies for that particular matter, I think that will be different. Asking accounting principles to change because of certain situations, I don't think that will be desirable. If I ask somebody today, don't get the external confirmation because external confirmations could reveal certain other things, I don't think that will be desirable in any case. I think we need to keep on applying accounting and auditing standards in these tough times also. Based upon that, whatever is the result, we will come out with that. Basically, the market knows that it is because of the COVID-19. Let's be very clear about it. You see, we should not create this situation which can blast later on. We should bring out to the public what is actually genuine in the case of the stock market. And let the stock markets have already discounted certain things. In any case, the stock markets, if at all, had to react with regard to certain companies, they have already reacted to that. And today, bringing out something which will be a farce in some of the circumstances, I don't think it will be desirable.
Thank you so much. Next question is from Mohammad Hanif. He's asking that cash flow from the leases are expected to decrease in next 2 to 3 years. What are the best method to value real estate properties? Is it better to use Gordon growth model or instead of perpetual growth model to discounted the cash flow within the income approach? Your take, please.
Scott, please go ahead.
I hope you agree with my answer. My view, I think the Gordon growth method is much more flexible, and I think I would recommend that approach. Mr. Kumar, would you agree?
Yeah, I agree.
Next question is, under the current situation where the business outlook is very grim, companies are unable to ascertain the correct impairment and finally take very conservative approach to end up with a high impairment. After a few months, if the market improves, then in the next year, there will be a huge reversal of the impairment, which will improve the profitability. Will the company show abnormal result due to this because of the reversal and other things? So what is your take and how the company? Sorry.
To my mind, at least, there is nothing abnormal in this. If you are following an accounting standard brings in impairment, you will impair. If it brings in reversal, it will create reversal. It is not abnormal. Well, let's be clear so far as this particular part is concerned. And COVID-19 is a kind of situation wherein probably the impairments could be heavier in the present circumstances. But there could be certain industries which may not revive. And if these don't revive, there will be no reversal also. And certain industries may reverse at a slow pace. And then in those cases, the reversal could be also at a slow pace. So let's leave it to the market forces actually, how the reversal has to take place or what the reversal has not to take place. Let's not get into that the accounting standards need to be changed as a consequence of it. I don't think that's required.
Okay, we'll take one more last question, please. And it is from Mr. James Ravi. He's asking, like, if the return ROU asset is impaired and the CA is reduced without corresponding reduction in the lease liability, will it result in imbalance in the balance sheet?
No, James, happy to note that you are attending today. Greetings to you. So as well, James, ROU asset at the time of initial recognition, asset is recognized at 10 million, liability at 10 million. But as the lease term progresses, it is not necessary that both the values should be same. It's not necessary that both needs to be same because both of them take an independent amortization approach. Having said that, as far as ROU asset is concerned, if it gets subject to an impairment, when the fall in asset value happens, the charge would go to your income statement and thereby your overall equity shareholders money, and the balance sheet would tally. I would make it little simpler by going back to the IAS 17 scenario. If you recall IAS 17 scenario, finance lease, we used to capitalize the asset and treat it as a liability. So those cases also, the finance lease asset, when it's subject to impairment, you went down, the liability got amortized independent of that. So there won't be any significant impact on the balance sheet. They would balance themselves.
Thank you so much. And now I hand it over to CA Mohammad Safiq for the vote of thanks.
Ladies and gentlemen, a very good evening. It's my privilege to have been asked to propose a vote of thanks. Thank you all for joining us today evening. I, on behalf of a managing company of Committee of ICA Abu Dhabi chapter, and on my own behalf, extend a very heartfelt vote of thanks to all the speakers of the evening. Having chair Executive Committee World Congress of Accountants and the former president of ICI is itself a huge honor. Thank you, CA Praful Chatterjee, for the winsome keynote address. The small virus and the chartered accountants roles you said summed it up all. I must mention our deep sense of appreciation for CA Abbas Ali Mirza, a partner at Deloitte and chairman 21st session International Standard of Accounting and Reporting, United Nations, for being there with the chapter throughout the conclave, mentoring and supporting us. The energy, positivity, and the silver lining. Nothing can replace your enthusiasm, sir. Further, we are grateful to have Mr. Scott Wallen, a partner at Deloitte Middle East, for taking us through your rich content on impairment testing, giving us a crisp yet interesting insight and statistics into the market, focusing GCC in particular. CA Amarjit Chopra sir, I'm sure the audience from around the world have had one of their best experience hearing and parallelly learning from you. But I feel so much extra honored to thank someone whose contribution to ICI and our community at large is beyond many of our dreams. Thank you, CA Amarjit Chopra sir, for sharing a glimpse of your masterly proficiency. Thank you so much. Now I have to thank someone who is very special to me, who has said it right. A truly great mentor is hard to find and impossible to forget. CA MPV sir, you are one such in many of our lives. We would never get over. Over your 20 years of teaching experience is cherished in thousands of hearts. I'm extremely humbled to do this honor of thanking you, sir. Thank you for teaching us one more time. Thank you, CA Umesh again, for the lovely moderation we got to see and for being an interactive master of the panel. You did a great justice to the role. Thank you so much. I would like to express thanks to all the management committee of ICA Abu Dhabi chapter, particularly XCOM and PDZ. Thank you, Neeraj and IGG, for all the support extended to us and me in particular. Finally, I would like to take this opportunity to place on record our gratitude to sponsors, of course, without whose generous support event of this nature are not possible. Our lead sponsors are UA Exchange, NMC, Platinum sponsor Etisalat, Emirates Motor Company, Gold sponsor Lulu, Commercial Bank of Dubai, Zoho, Crescent Manon, Silver sponsor Mamam, First Abu Dhabi Bank, Wadba National Insurance, and Barakat. Once again, thank you all for joining us today. It's been an absolute pleasure listening all. Have a lovely evening. Thank you all.
Thank you.
Thank you
Ajit
so
sir,
much.
thank you so much. MPV sir, thank you so much. And we wish that you sometime take out time for full session to address our members. I mean, I know you said that over webinar you are not so keen because you lack eye contact with the audience. And I appreciate your feelings, but we would definitely love to hear you a full session sometime for our members. Scott, thank you again for accepting our invite and appreciate your time. Abbas bhai, thank you so much for guiding us and taking us through this journey. And we look forward to your guidance furthermore. Umesh, you were excellent. I mean, you just raised the whole profile of the panel discussion and it was absolutely great. I mean, I would say, thank you so much.
Thank you so
Thank
much.
you, everyone. Thank you.
Thank you very much.
Thank you.
Good night.
Thank you, members, for
Thank you.
Thank
joining.
you, Abbas. Bye.
Thank you, sir.
Thanks, sir.
Thank you.
Thank you. Umesh bhai, good job.
Thank you, John. Thank you.
Very nice. Okay,
Thank you.
thanks.
Thanks.
Thank you
Bye-bye.
all. Thank you.
Thank you.
Bye-bye.